Hi, everybody. Good afternoon. I'm Lauren Simonetti in for Charles Payne, and this is Making Money. All right, stocks tumbling today as rising yields and rising oil prices reignite inflation fears. Take a look. You can see the S&P is down 0.5%. The tech-heavy NASDAQ down about 1%. And the Russell 2000 of small-cap stocks is down the most here. It's down 1.25%. And in and about face, folks, Treasury yields rebounding, wiping out yesterday's declines on the Treasury's big buyback news. The yield right now on the 10-year is 4.7%. Meanwhile, Walmart shares plunging despite their earnings beat. What happened? They posted their weakest sales growth in over 6 years. Joining me now is Erin Gibbs, SlateStone Wealth Chief Equities Strategist. Erin, what happened with the Walmart earnings report?
So it was interesting, and it really does highlight this K-shaped economy that we've been seeing. So they said the higher-end priced items are still doing well. They had some problems with prescriptions, but on the lower side in groceries was also still a struggle on the earnings growth side. They did make some announcements that they could get some tariffs that they would pass through to customers to try to cushion the blow, but it clearly hasn't worked, given where the stock's moving today. Yeah. But I think, again, the consumers are just being more choosy about where they're spending their money and exactly what they're going to buy, and that's reflected very much in Walmart.
Walmart is known as the place where richer people get deals. Yep. Love to go to Walmart. And where there is value for the lower end shopper as well. They cut prices on 11,000 items last quarter. And the CEO said, we're going to use these tariff refunds to keep prices really low. Are consumers just tapped out at this point, that even those low prices at Walmart aren't enticing enough?
I think that's what we're seeing, is that people just have to make decisions about if rather than both, or, just buying less, and that's what we're seeing, and we're going to see this play out certainly in the third quarter. It might also be that there's been a little competition from Target. They kind of got their act together.
They did.
Right?
They're cool again. They're new. Okay, you like Etsy, you like American Eagle. Why do you like Etsy?
So Etsy, they just sold their Depop to eBay. So that freed up a lot of cash. So they've got a lot of extra cash on the sidelines for CapEx. It really just streamlined the entire business, made the profit margins much more higher. So really looking good, and you can see that in the stock. Now, American Eagle is a bit controversial. I know that they've had a lot of bad press when it comes to some of their their women's wear, especially their women's bottoms, a little too short, a little too small. But what's really driving the growth, if you look past the headlines, is their Aerie brand is doing really well. And so that's for a little more mature, 30 plus, and they should probably just rename it Aerie, and the stock will go up. So
I know a lot of 10-year-olds that shop at Aerie, by the way. So that's why they make size like XXS. It's not for you and me. It's for like 7-year-olds.
Exactly, exactly. Well, even for somebody as tiny as you. But Aerie's doing really well. They're really strong growth, and I think once the negative headlines around American Eagle go away, I think we'll finally, if we start looking back to fundamentals, I think this is like a good place to be.
Okay, let's go up a couple levels. Luxury. You like Ralph Lauren?
I do. Ralph Lauren has luxury has been doing well pretty much across the board, but Ralph Lauren has just been really hitting it on all cylinders. Their marketing campaigns are exactly right. You're seeing it in the numbers of earnings beats and growth, exceptional growth, both in the U.S. and overseas, which is very important, particularly on luxury brands. And so I think, even though we've had this massive run this year, there's nothing that's saying that Ralph Lauren is cracking, that there's any slowing on the growth side.
Okay, so the consumer is still, what's the adjective?
Bifurcated.
Okay, selective.
Selective. Yeah.
Let's pivot to some drug stocks. I mean, you can't ignore the rally that we saw in Moderna yesterday, up 177%. Who cares that it's pulling back today? Merck hitting record highs on that cancer trial, the success of the cancer vaccine. But staying with the biotech space, you like Corcept and Excelis? Am I saying that right?
Honestly, I pronounced it Excelis, but we'll just call it Excel to make it easier for us for today. So yeah, Corcept Biotech, it focuses on cortisol treatments that help with Cushing's syndrome and types of ovarian cancer.
Okay.
Excel does a different type of...
That's a beautiful chart, by the way, not to interrupt you. The Corcept chart, the 6 months, straight up.
Yeah, and so there's a lot of growth built into those numbers. So they've had multiple drugs approved, and so the expectation is they're going to continue to have multiple drugs approved. And so we see, like with Moderna, it can happen. It can really drive up those prices. So it is a risky bet. It is highly priced right now. There's a lot of growth story built in there, but they have been knocking it out of the ballpark and getting like more and more drugs approved. Excel is they disappointed in the last quarter. The growth wasn't quite there, but they've got a couple new drugs that have to do with types of colon cancer treatments. And again, if that gets approved, comes out, very big numbers, very big beats, and that chart should look a little better.
Well, oncology seems to be where it's at. It's like the next frontier. And I've been saying for the past 2 days, correct me if I'm wrong, but it seems like the biotech space is the new AI space. It's where we can see just all of this growth. Everybody's pouring in, and AI is helping with drug discovery.
Absolutely. And so I really both of these companies have drugs that are already approved. They have cash flow. It's not like these guys are going out of business if they don't get an approval, but the growth and the real acceleration on the stock prices is going to come with those future approvals.
Gotcha. Some large cap companies, they're loading up on debt, not always for bad reasons, but they're still doing it. And the small caps are becoming more conservative. Is that making the small caps safe plays?
Well, when their growth has been very small compared to the S&P.
Okay.
In fact, their growth has been
the blue is the small cap.
The blue is the small. This is Russell 2000. This is the S&P 500. So inherently, if you're a bigger company, you can afford to take on more debt because you get it at cheaper prices. But you can see the acceleration has definitely been higher in the large caps. Actually, this is almost about the pace of inflation. So they have been growing.
And that's been steady, though.
And it's been just a steady sort of inflationary pace. So the thing with small caps, obviously, you take on a lot more debt when you're a younger company. You need to. You have to be able to borrow money in order to grow your business and put all these plans into. So for the scale of the company, yes, the debts it's much larger for the scale of your company. The good thing is that they're being conservative. They're not being aggressive. We're not seeing these huge spikes in growth and debt. They're just basically keeping up with inflation. And so that has actually made them more attractive from a balance sheet perspective than a lot of the large caps right now.
So you're saying this is safety. The fact that those blue bars are relatively at the same
relatively
level
high.
is safe.
And it's saying also that, look, they could have gone on this massive CapEx spending spree, but they haven't. They've stayed more conservative. Even as rates have come down in 2025, they've still had relatively lower levels of debt. And so even if rates do go up 1%, they're still able to pay those interest rates. It's not going to kill their profit margins.
Erin Gibbs, thank you. Good to see you.